Well, welcome to the Pinnacle Perspectives update for 2022 and wishing everyone a healthy, happy, and fulfilling year ahead. My name's Mark Cormack. I'm a Director of Distribution at Pinnacle Investment. And today I'm delighted to have Michael Bell, who's the Joint Chief Investment Officer at Solaris Investment Management. In terms of background, Solaris are an independently owned Australian equity fund management boutique who've outperformed the ASX 200 in 16 out of 21 years. And importantly, the core of the investment team have been together since the early 2000s. Michael, thanks for joining me.
Yeah, I'm glad to be here. Thanks, Mark, for the opportunity.
Look, let's get straight into it. After a challenging 2020, it's great to see the Solaris funds delivering some strong performance for the financial year so far. Take us through your thoughts on the market in the second half of the year and what's really been the drivers of that performance financial year to date.
Yeah, glad to do that. Thanks, Mark. So I actually might take you through the 7 months because January's been such a big month for markets. So yeah, going financial year to date, three themes have really stood out to me. So one is M&A. The other one is commodity prices and input prices. And the last one is what happened in January, which is a rotation from growth to value. So from an M&A perspective, you can see on this first slide that we've got up here, the top chart on the right, the green bars are the ones that have outperformed, the sectors that have contributed most to the down 2.7% for the market. So most of that damage of down 2.7% was done in January, where the market was down 5%. And from an M&A perspective, you've seen utilities have done extremely well. So within the sectors that I look after personally, there were takeovers in AusNet, Spark Infrastructure, and in transport, which I consider infrastructure. There was a takeover of Sydney Airport, and they're all done at probably about a 40% premium to market. And that gives us a bit of comfort as listed investors in some of these parts of the market that the unlisted guys, and all these takeovers were done by unlisted players, it gives us some confidence that if the listed players in the market don't value these companies properly, then the unlisted guys will come in and buy them. So we've got a few infrastructure plays that we believe are fairly undervalued. And so as a backdrop, that gives us a lot more confidence there. So M&A, there's a fair bit of M&A apart from those. On top of that, you had, in terms of other stuff happening, you had commodities. So commodities had a massive boom over those 7 months, and it's particularly gone crazy in terms of share prices in the last month and a half. And so the bottom left chart that you can see there is some of the commodity prices. So iron ore came off the boil just a little bit, but other commodities, coal, which we all thought was dead, coking coal was up 160%. Similarly, thermal coal was strong. We had some of the future-facing metals, such as nickel and aluminium, all up about 20% over that period. And lithium was up a staggering 330%. So in terms of what performed in that part of the market, so metals and mining shares contributed to the positive performance in terms of the market. It was the mid-cap and the smalls that did extremely well. That bottom right chart shows that some of the large cap names didn't perform so well. So BHP was down 5%, Rio's down 12%, and Fortescue down a bit more. So it's that mid-cap space that was getting the benefit of the leverage in the market. Now, on the downside, in terms of what dragged the market down, because I said the market was down 2.7% for that period, and most of it happened in January, was that growth value rotation. So that's seen software and services down materially, down 15%. And we saw the healthcare stocks, which are growth stocks, down about 10%. And a number of those healthcare stocks are those COVID beneficiary stocks that did really well during COVID and are now coming off the boil. And in the software and services sector, these are names such as Afterpay, or they're called Square now. They're really coming off hard. So it's now probably down 50 to 60% from its highs of $160. So big moves in the high growth part of the market. And that's not just happening in Australia, it's happening globally, as people would note. And that started in November and really extended into January. And so it's a really interesting time for markets, for us, and looking at opportunities. But where did we make alpha, Mark? Which is probably what everyone is asking. And we have had a good time over the last 7 months. And what has really changed for us, and if we go to the next slide, we can see in terms of some of the stocks that we own in the portfolio where the alpha came from. And what we believe is happening with the market that is different to what happened during COVID is we believe we've come into a more normal type of investing period. Now, the markets may be volatile, but it feels more normal in terms of investing for us. And what I mean by that is that during those 12 to 15 months of COVID, the market had this fascination of they were focused on earning certainty and only focusing out for the next 6 to 12 months. Now, our process is built on looking outside the next 6 to 12 months because we believe that that time frame is generally well known, and looking at valuations 2 to 3 years out. And the market just wasn't doing that during that period of COVID. But in the last 7 months, we've started to see the market looking outside that period, which is really, really encouraging for us. And we feel like the market's coming back to normal investing. So for a while now, we've said that we believe that we're going to see 3 buckets of outperformance in the portfolio. Those COVID recovery names, they're names that we had in the portfolio that didn't do well during that period. And they're names that have started recovering now, yet some of their operations might still be impacted. So Ramsay Healthcare, for example, elective surgery is still impacted in Sydney and Melbourne. IDP Education, again, another stock. Atlas Arteria. So there are a number of stocks that are still impacted, but the market is now starting to look through COVID, which is very encouraging. The other pocket which delivered was growth companies, reasonably priced growth companies in the portfolio. So these are companies that we've had for a long time during COVID that continue to deliver. Names such as James Hardie, Goodman Group, Charter Hall, Cleanaway. So very encouraged to see performance coming through despite the rotation in that part of the market. And then finally, in the value space, we've got some interesting value companies that have done well during that period. Macquarie Bank. So that did well during COVID and continues to do well. They had a result in November and it exceeded expectations, and we saw some pretty decent upgrades. It's on a multiple that's not very challenging either. So we have a lot of conviction there. Some of the resources are doing well as well. So BHP, Rios, Incitec Pivot's a new position in the portfolio that we introduced probably July last year. It's something we haven't been in for 10 years, but it just looked reasonable value from a value perspective. So that's where we're seeing the outperformance over the last 7 months, and we expect that to continue across those 3 buckets, Mark.
So let's drill into it a little bit closer, Michael. With all that talk about inflation, growth, value, how do you see Solaris positioning the portfolio to kick off 2022?
Well, inflation, the use of inflation has been massive with our clients, and every meeting we go to, they ask us about what's your view on inflation, how's it going to affect the portfolio, and how are you positioned. So inflation, it started off by the talk on all these higher costs, are they transitory, and now it's morphed to the Fed's going to put through 4 rate rises this year, and that seems to be what's factored into markets at the moment, and rate rises in Australia. So, and very quickly the markets start reacting, and as you saw in December, January, that rotation was as a result of the market starting to factor in interest rate rises. Now, in terms of what's happened to what's happened to growth and value stocks and where we're positioned, if you look on slide 4 on the left-hand side chart, and I've showed this before, over the last 2 years, you saw growth companies materially re-rate upwards. And so you saw the PE, which is a pretty crude way of looking at growth companies, but just gives you an indication of how expensive or not a company is, re-rated from 25 times to 45 times in the space of 2 years. So massive re-rate. And that coincided with a fall in interest rates. And we do have sympathy with some of these companies re-rating on the back of that, but we did believe that it'd run way too hard. Now, what you see now on that same chart is you've seen those high growth companies derate. So they've gone from 45 times now down to 32 times on our numbers. So massive re-rate and extremely quickly. But what it does is it creates opportunities. And if I now talk about where we are positioned on the top right chart, this is a chart that shows our style exposure in terms of growth and value, and it shows how active we are. And for a number of years, we were slightly overweight growth companies. And about 12 months ago, we went overweight value companies. Our analysts who build the portfolios from the bottom up, we're seeing many opportunities in terms of value coming from that part of the market, and growth companies were starting to look expensive. Now, it looks like we went a little bit early in terms of that switch from growth to value. And as I said, it's built from the bottom up. So we don't take a top-down view that we want to be long growth or long value. It was based on the analysts' opportunities that they were seeing. And so at that point, we started moving overweight to value. And I mean, that's helped in the last couple of months. But more recently, you can see that it started switching a little bit the other way. So we've just started seeing a few opportunities arise in growth. So with this volatility, Mark, we've been seeing some really good opportunities to add to positions, reasonably priced growth companies in the portfolio, stocks such as James Hardie, CSL, and SEEK. And James Hardie was down about 25% at one stage. Very, very good value and a great opportunity. And we will see more opportunities, and we will take advantage of them.
Okay, look, reopening is another big theme you mentioned, and in the portfolio throughout 2021 as well. Take us through your thoughts there and how you're viewing reopening stocks.
Yeah, so we do have as you know, we do have a number of reopeners in the portfolio, a number that hadn't worked during that COVID period, and a number that have started to outperform now. And we believe there's plenty to go in terms of those reopeners. And you can see some of them on the screen here on slide 5. But what's really important with these companies is three things. And we've been saying this for a while, is that as we're going through COVID, you want to make sure that you've got a stable or improving industry structure. We don't want to be in companies that the industry structure is destroyed as a result of COVID. So that's the first thing. The second thing is we want to avoid excessively geared balance sheets, because we don't know how long COVID will last for. We're not making a call on how long it will last for, but you want them to be able to survive whatever cycle of COVID, or whether it's a commodity price or whatever it is. Whatever happens, you want them to be able to survive and not be stopped out by having a bad balance sheet. And the third and final thing is making sure they've got the right management to get them through this. And you've got a list of stocks there on that slide. Some have started delivering outperformance, while others are yet to deliver outperformance. So there's plenty of latent alpha left in those reopeners for us and our clients.
Fantastic. And look, and finally, we're coming into the February reporting season. What is getting the Solaris team excited in terms of stocks? And can you outline some of the favoured positions that are in both growth and value segments of the market?
Sure thing, Mark. So if we think about the reporting season, the first thing I think about is what sort of earnings changes have we seen coming into reporting season? What's factored in, what's not? And we have actually seen upgrades, surprisingly, coming into reporting season. That's mainly come from healthcare and the resources sector. And the resources sector is really through higher commodity prices. So you're seeing some mark to markets from people. But interestingly, the growth part of the market has seen some upgrades, and that's despite material moves on the downside in terms of share prices. So the fundamentals for the growth companies aren't particularly changing too much. It's just the stock prices. Now, what do we think in terms of results for reporting season? So we believe that the half that's just gone by will probably be quite reasonable for companies. Top line growth will be solid. Balance sheets will be extremely solid, so there'll be opportunity for more M&A by the listed players. And so top line growth, balance sheet's pretty good. On the downside, we believe that you'll start seeing impacts from higher costs across the board. So we're all aware of higher freight costs, et cetera, coming through, and that'll be a theme of reporting season. And what we believe you need to watch out for, which people haven't really been talking about over the next 6 to 12 months, is wages inflation. So everyone's been talking about input and cost inflation, but the big thing that we'll be watching out for is wages inflation and how that affects some of the companies on exchange. Now, if I turn to stocks that we like, Mark, in both COVID recovery, growth and value, there's 3 stocks I would highlight: Atlas Arteria, James Hardie, and Macquarie Group. So Atlas Arteria, I've probably talked to death in the past, but that is a COVID recovery name that is seeing traffic in France back to pre-COVID levels. So encouragingly, things are back on track there. That's despite cases in France being very elevated. So it's The economy's back open there, but we're seeing the share price hasn't recovered yet to pre-COVID levels, so well below. Why I get excited with Atlas Arteria is that they've got a very lazy balance sheet. And the biggest drawback I get from people when I talk about Atlas Arteria is, okay, Atlas Arteria, great, undervalued, but it's got a short concession life. And one thing they can fix is their concession life. So they've got a lazy balance sheet. They can use that balance sheet to increase their concession life, work with the government. The government wants to improve the roads over in France, and one way of doing that is using the private operators, including Atlas Arteria, to achieve that. They've got the balance sheet to spend. They can borrow money, 10-year money at 70 basis points, which is just extraordinary. And so we expect post the election in France that we will start seeing some concession extensions coming through for Atlas, which will help with the re-rate there. In terms of growth, James Hardie is one of our bigger positions in the portfolio. They've done extremely well. What we do see over there is housing starts remain strong, 1.6 million per annum, which is a really, really big number. It's only just above the 50-year average, but it's a strong number and will help them. In addition to that, the repair and remodel part of the market over there, James Hardie is gaining market share, and they're gaining market share from competitors, so that's all on the top line. On the cost side, they've been doing fantastically in watching their costs and reducing costs across the board. And during COVID, they did a fantastic job on the supply side, making sure there was sufficient inventory available for their clients, which is some of the other competitors weren't able to maintain supply like they were. So that's another position on the growth side that we think has got plenty of upside. Now, in terms of value, Macquarie Bank is our biggest position there. It's trading on about 13 or 14 times, well below the market PE, so it's extremely cheap, but it continues to outperform. And as I said, they had a great result in November. They exceeded market expectations, and we saw consensus upgrades of about 10%. Now, with Macquarie Bank, they're effectively long volatility through their commodities business, so they benefit from commodities volatility. They'll benefit from the freeze we're having over in the States at the moment, and they are also long climate change, and that is a massive theme. And I'll give you an example of how they can make money on climate change. So the Singapore government might come to them and say, okay, we want Macquarie to help out building an offshore wind farm. And they can be very complex, a lot more complex than onshore wind farms. So Macquarie Bank comes in and they advise the government on how to do it. So they clip the ticket, ching. The next thing they do is they come in and they help develop it. And they take the margin for developing, ching again. And then the last thing they do is they help manage these assets, and they co-invest in the assets themselves, so they've got alignment. So again, they're clipping the ticket again. So it's a very powerful model. They seem to be streaks ahead of the competitors in terms of where it's going, and they are long climate change. So that's a stock that we believe has got plenty of upside from here.
Look, Michael, thanks so much for taking us through Solaris's deep insights and analysis. Look, as I mentioned at the start of the video, Solaris are an independently owned Australian equity fund management boutique who have outperformed the ASX 200 in 16 out of 21 years, which is quite an extraordinary achievement. Solaris are also one of the very few fund management teams who truly back their investment management capability by having a fund which is the Solaris Core Performance Alignment Fund, which has a 0 MER. It only charges a fee if they outperform the index. And it's important to note that Solaris won't be charging any fees on that fund until they recoup any of their previous underperformance. In closing, Solaris also have other offerings in the Australian Equity Long Short and the more recently launched Australian Equity Income Fund, both of which have some outstanding ratings from both Lonsec and Zenith. If you are after any further information on the Solaris funds, please do not hesitate to contact a member of the Pinnacle distribution team or refer to the Solaris website, solariswealth.com.au. Thanks for watching and have a great day.